2025, bank executives and directors have expressed more enthusiasm for M&A. There were two things we needed to happen in order to motivate M&A in the environment, being a rebound in bank stock prices and interest rates to start to pull back again. And both of those things have started to happen and are anticipated to continue moving in the right direction in 2025, which is increasing the enthusiasm for M&A. Those motivators for why an institution wants to execute M&A haven't changed. We still have succession planning concerns, we want growth, we want scale, we want efficiencies, and those drivers have been there, but the environment we were in made it difficult to actually execute on your M&A strategy because the deal financials just weren't there. Now that those two things have moved in the right direction, we've seen more alignment in pricing of deals, which allows the deals to be done, and we've seen the unrealized losses start to pull off the portfolios, which again makes the deal math work. And so now institutions who have those plans have been able to capitalize on their strategy and are anticipating return to more normal M&A activity in 2025. Potential buyers in 2025 could be motivated to make an acquisition by a number of factors. But as responded in the 2025 Bank M&A survey, 85% of potential buyers thought that a strong deposit base was the most beneficial thing in looking for a target. And that factor doesn't anticipate changing throughout 2025. As we talk with bank executives and directors, strong deposits, customer growth, and then synergies are still one of the most important driving factors in why they would want to execute M&A. And one of the things that's motivating that is the increase in stock prices, generally speaking, across the industry, which allow those potential buyers to really capitalize on their need for acquiring those customers. In the banking industry, there's a lot more competition, especially from non-bank financial institutions, which are trying to steal customers and are attracting more customers across the nation. Additionally, given the increase in online banking and other activities, your competition isn't just the bank down the street anymore, it's banks around the country. And so when looking at what could motivate M&A, the customer acquisition and that strong deposit base is still a driving factor. And the increase in stock price is allowing those banks who are really driven by that to pay the premium that they're looking for to attract that potential seller. Within the banking industry, we've seen an increase in competition for these strong deposit bases by non-financial institutions, which are attracting more consumers across the industry, as well as the prevalence of online banking, which creates competition not just from the bank down the street, but around the country now. And so this flows through into why there is an emphasis on the importance of attracting that strong customer base and looking for a book of strong deposits when executing an M&A strategy, just because of that additional competition in the environment. In the year ahead, there are a number of things potential sellers can do to position their bank to get a better price in an M&A transaction. Unfortunately, there's no one-size-fits-all solution that can be used for every institution, but generally speaking, it starts by looking internally at where your potential black holes could be. We're seeing an increase in potential sellers looking to do sell-side diligence on themselves prior to a transaction to try to identify some of these weaknesses and areas where they can better position their institution to get that price they're looking for. Two of the big areas that we see focused on are the loan portfolio and potential concerns in commercial real estate, as well as the deposit book and how we can make those long-lasting relationships with our customers so that they will maintain their relationship post-transaction. As we saw from the bank respondents who are potential buyers in the 2025 Bank M&A survey, those are some of the factors they're still looking for. They want a strong deposit base and they want a strong balance sheet that can perform positively in the years to come. And so looking internally and identifying those weaknesses can allow you to strengthen those relationships you have with your customers, prove that you have cross-channel and cross-product functionality with them, allowing those relationships to maintain post-transaction and provide that benefit to the buyer. In this environment, bank leaders should maintain their focus on capital and ensuring adequate capitalization so they can execute on their M&A strategy. We've seen an increase in regulatory scrutiny over adequate capitalization, specifically relating to the decline and low levels of credit losses that we've had in the environment, which are contrary to the potential risks that we're seeing perceived in portfolios, specifically around commercial credits and commercial real estate. Generally speaking, from a regulatory perspective, there's an expectation that losses are in the portfolio and reserves should capture and provide for the potential for those losses. And so the increase in credit risk creates an additional pressure on capital, as well as within an M&A transaction. Generally speaking, in the short term, there's pressure on capital until you can start to get that earned back from the accretion from those fair value marks. So generally speaking, as bank executives are looking at their capital position, it's important to be doing things to structure their levels of capital so that they can execute on their strategy. And one of the things that we've seen being considered recently is raising capital in conjunction with executing that transaction. While not every institution needs to do this, for some who may have lower levels of capital or may be executing a transaction with significant fair value marks, it may provide that extra cushion to allow you to get over that initial hurdle and have a transaction which is both approved and structured in a way that's beneficial for your shareholders. In 2025, the outlook for organic growth is promising but challenging for financial institutions. As we've talked about with the increase in bank stock prices and the reduction in interest rates, M&A was a promising avenue and looked upon as a promising avenue for growth in 2025. But those situations also create an environment where organic growth could be beneficial. With the reduction in interest rates, we've seen a situation where there's large commercial real estate relationships which will be repricing at levels much higher than their original rates, which is creating pressure for borrowers, but that creates an opportunity for other financial institutions to potentially take that relationship and grow their own books by providing either a relationship to that customer that's more beneficial to their situation or structures or the products which meets their needs in the current environment. So as we see the environment moving in this direction, it offers the ability for institutions to try to grow organically and grow lines of business that they may not have been as beneficial with in the past. Additionally, when we look at the overall economic outlook, the survey respondents for the 2025 Bank M&A survey generally thought that there was promising economic growth on the horizon. And with economic growth comes an opportunity for institutions to develop new relationships and to grow their loan books to support and stimulate that growth. And so as we see, generally speaking, that favorable outlook for the economy, it allows institutions to really focus on delivering those products and delivering those relationships to help stimulate that growth for their institution.